Hey everyone, and welcome to our deep dive today.
Yeah, it's great to be here.
We're tackling this really interesting topic.
Building a retirement portfolio.
You can generate income reliably.
Even when the market's not doing so hot.
Exactly.
Which is something on everyone's mind, I think, these days.
For sure.
So we'll be focusing on closed-end funds, or CEFs.
Those are becoming super popular, right?
And REITs, too.
Real estate investment trusts.
Yes.
Okay, so we've got a really interesting mix of sources for this deep dive.
Yeah, I'm excited to dig in.
I've got your personal notes, which is fantastic, plus the book, How to Retire on Dividends.
Great book.
A briefing document called High Yield Income Strategies for Retirement.
Very relevant.
And a FAQ, all about CEFs.
CEFs are having a moment, for sure.
Yeah, they are.
Lots of questions about them.
So one thing that I thought was super interesting that pops up in a lot of these sources
Yeah, what's that?
is this whole idea of a no-withdrawal portfolio. You build a portfolio that can cover all your expenses.
Just from dividends and interest.
And you don't have to touch the principal.
You never have to sell anything.
I mean, that sounds like the dream, right?
It's definitely appealing.
So the book, How to Retire on Dividends, makes this really interesting argument
Oh, yeah? What's that?
that the bond market is just way less efficient than the stock market.
Ah, I see where you're going with this.
And there's this great quote: "Big money is spent on television print and online advertisements for ETFs. Less cash and thought is put into the actual income strategies that ETFs employ, and their lagging returns reflect it."
Ouch, kind of a burn on ETFs.
Yeah, I mean, but if you're looking for income, it seems like.
Maybe they're not the best vehicle.
So that's where CEFs come in.
They can be a powerful tool.
So could you walk us through some of those differences?
Between CEFs and bond ETFs.
Yeah,
So CEFs have a dedicated portfolio manager who's making decisions.
they're actively managed.
Exactly. They can also trade at a discount to their NAV.
NAV, that's net asset value.
Yes. It's basically the per-share value of all the assets the fund holds.
Okay.
Now contrast that with bond ETFs,
Okay.
which are passively managed.
So they're just tracking an index.
And they usually trade right around their fair value.
Okay.
And they can even have problems with liquidity when the market gets choppy.
The book also talks about how CEFs can use leverage.
Oh, yeah, leverage.
And that always sounds a bit risky.
It's basically borrowing money to invest.
Okay.
So if the investments do well, the leverage can really juice your returns.
But if they tank?
Then those losses get magnified too.
So it's not for the faint of heart.
It's definitely something to be aware of.
Now, I remember there's this fascinating example in the book.
Oh, which one?
It compares a bond CEF.
Okay.
It was run by Jeffrey Gundlach
Oh, the bond god.
to some of the super popular high-yield bond ETFs.
I think I know where this is going.
Yeah, and the CEF totally crushed those ETFs,
It's a great illustration of how active management can sometimes win.
especially in an inefficient market like the bond market.
For sure.
Okay, but then there's also this note of caution.
Right.
The book says some funds pay big distributions that look great, but they're not sustainable.
Oof. Yeah, that's a good point.
So how can we tell if a dividend is really sustainable or if it's,
Too good to be true.
yeah,
Well, one key concept is understanding destructive return of capital.
that's when a fund is basically just paying you back your own money,
Right. It's not actually generating income from its investments.
and it erodes the value over time.
Which makes it harder to keep those dividends coming.
So you really want to scrutinize the source of those distributions,
Make sure they're from investment income.
not just returning your principal.
Exactly.
And then there's dividend growth.
Ah, yes, dividend growth.
Why is that so important for long-term returns?
Well, think about it. Consistent dividend increases attract investors who are looking for growing income.
Okay.
And that demand pushes up the stock price.
So it's a virtuous cycle.
You got it. The book says, rising dividends create rising stock prices because they create more valuable underlying assets.
So if a company's raising its dividend...
It's probably because the underlying business is growing too.
Okay.
But the book also suggests this kind of contrarian approach.
Oh, yeah. Tell me more.
Specifically for municipal bonds. It says to buy them after mini panics.
Interesting. So why is that?
Well, the idea is to kind of take advantage of market fear
I
when
see.
everyone's panicking.
They sell indiscriminately.
And that creates buying opportunities.
For those who can keep a cool head,
The book even has an example about default fears with munis.
where the prices drop way too low, and that's when you can swoop in.
Smart.
Okay, so let's talk about this no withdrawal portfolio.
Yeah, let's get into the details.
So the book recommends splitting your portfolio into 4 buckets. The first one is go anywhere bond funds.
We've talked about those a bit.
They're actively managed.
Right, the manager can invest across different sectors.
And global markets, too.
So they're not limited by a specific index.
So they can really chase those yields wherever they are.
That's the idea.
Okay, bucket number 2.
That's that one.
Secure, boring bonds.
Ah, yes, the foundation of the portfolio.
These are like your high-quality fixed income,
Munis often fall into this category.
providing that nice, stable base.
With some tax advantages, too.
Alec, what's bucket number 3?
Okay, that's recession-proof REITs.
Recession-proof, huh?
The idea is they focus on sectors that aren't as affected by economic downturns.
Like healthcare.
Healthcare, data centers, certain types of commercial real estate.
So even if the economy takes a hit,
These REITs should keep chugging along.
generating that steady rental income.
Right.
Okay, last bucket.
Bring on.
Commercial landlords.
Ah, another interesting one.
This includes REITs and BDCs
Business development companies.
that lend money to commercial properties,
So you're capitalizing on the demand for financing.
but with potentially higher yields.
Exactly.
I like it. So those are our 4 buckets.
A diversified, no withdrawal portfolio.
It's all starting to come together, but before we get too excited,
Right.
we also need to talk about the risks.
Of course, every investment has risks.
So what are some of the things we should be watching out for?
When evaluating these investments for our no withdrawal portfolio,
Okay.
well, one of the first things to look at is the payout ratio.
Payout ratio. Tell me more about that.
It's the percentage of a company's earnings that are paid out as dividends. So
Okay.
if the payout ratio is really high,
Like over 80% or 90%,
that could be a red flag.
especially if there are other warning signs.
Like high debt levels.
Or declining earnings.
Mm.
So it might mean the company's having to stretch to make those payments.
Or even worse, funding those dividends with debt or asset sales.
Instead of actual earnings.
You definitely want to be careful about that.
Okay, what about debt levels? How can we tell if a company has too much debt?
Too much debt can really weigh on a company's profitability.
Yeah, and make it harder to keep paying those dividends.
Especially if the economy hits a rough patch.
So we want companies with a solid track record of managing their debt responsibly.
Exactly.
Okay, so we've got payout ratio and debt levels. What else should we be thinking about?
Management quality is always a key factor.
Makes sense. So what are we looking for in a management team?
You want to experience a strong track record of success,
So we want those smart, capable people
who have a history of making good decisions.
that benefit the shareholders.
Right?
Now, I remember you mentioned earlier that we need to be cautious of REITs with external management.
Ah, yes, that can be tricky.
Can you remind me why that is?
So with external management, the company's management is handled by a completely separate entity,
Okay.
and that can create conflicts of interest.
How so?
The external manager's goals might not be aligned with the goals of the REIT's shareholders.
I see. So there's a potential for them to prioritize their own profits.
Over the best interests of the REIT and its investors.
Okay, that makes sense. So thorough research is obviously essential here.
It's non-negotiable. You need to understand the risks,
The company's financials,
its industry,
the management team,
and its overall track record.
and it's always a good idea to talk to a financial advisor,
A good advisor can be an invaluable resource.
especially when you're making big investment decisions.
They can help you create a plan that's tailored to your individual needs and your risk tolerance.
Okay, so we've covered a lot of ground here,
We've barely scratched the surface.
but let's step back for a second
Okay.
and revisit this idea of bond ETFs.
And why the book seems to be so down on them.
Yeah, compared to CEFs.
As we've discussed, bond ETFs, while they offer diversification, can sometimes underperform those actively managed CEFs.
Especially when the market gets volatile.
Or when we see those inefficiencies we talked about
And they can also face liquidity problems,
during those times of market stress
which can lead to those price distortions.
and potential losses.
Now, the book also mentions this thing called buying by size.
In a bond market,
I'm still not quite clear on what that means.
so buying by size essentially means that you're allocating capital to bonds based on the market value of the company issuing the bond.
Okay, so bigger companies get a larger allocation.
Right. But the book argues that this approach can actually work against bond investors who are looking for safety and consistent income.
Because it could lead to too much exposure to those companies with the most debt.
Exactly, and that doesn't really align with minimizing risk.
Especially if you're really focused on generating that reliable income from your bond investments.
Makes sense.
So when we're looking at any kind of bond investment,
Whether it's individual bonds, bond funds, or ETFs,
We need to think about more than just the size of the issuer
We need to consider the credit quality.
and whether that income stream is sustainable.
You got it.
Okay, now let's switch gears for a minute and talk about a specific type of REIT,
Which one?
REITs.
Mortgage REITs.
We talked about how they can be really sensitive to interest rate changes.
They are.
Why is that again?
So REITs are a little different from other REITs because they primarily invest in mortgages rather than physical properties.
Okay.
And when interest rates go up,
The value of their mortgage portfolio can take a hit
which can lead to dividend cuts.
and lower returns for investors.
Right, so it's important to factor in the interest rate environment when considering RINs.
And your own risk tolerance, too.
Absolutely.
Okay, now, BDCs, business development companies,
We've touched on those a couple of times.
they are kind of similar to REITs in that they have to distribute a lot of their income,
At least 90% of their taxable income to shareholders.
which can lead to those nice, juicy dividend yields.
Yeah. But BDCs often invest in companies that are less established.
Than those that traditional banks would lend to,
Right, so they tend to be a bit riskier.
especially when the economy's not doing so well.
You're trading that potential for higher income with a greater chance of defaults,
So diversification is really key.
as with any investment strategy.
Now, I know the book also goes into mutual funds and ETFs more broadly.
It's good to have a clear understanding of the differences between those two.
They're both super popular.
They are, and they both allow you to diversify.
By investing in a basket of assets.
But there are some key distinctions.
So what are the main differences between mutual funds and ETFs?
One of the biggest is how they trade.
Oh, okay.
Mutual funds are only priced and traded once a day.
After the market closes,
So you place your order.
and it can be executed at the NAV.
That's calculated at the end of the trading day
Okay, so it's like a snapshot.
of the fund's value at that specific point in time.
What about ETFs?
They trade on stock exchanges, just like individual stocks.
Okay.
So their prices fluctuate throughout the day.
You can buy or sell them anytime.
And you can track the price movements in real time.
Nice.
Another difference is fees.
Ah, the fee.
ETFs typically have lower expense ratios than mutual funds
Which can add up over time.
and eat into your returns.
So if you're looking for cost-effective investing,
ETFs often have the edge.
but there are also actively managed ETFs.
Right. And just like actively managed mutual funds, they tend to have higher expense ratios.
Than those passively managed ETFs.
So the choice between active and passive really comes down to your investment philosophy.
And how much you're willing to pay in fees.
Exactly.
Okay, now you mentioned earlier that the book also talks about that buying by size thing.
In the context of bond ETFs.
Right, and it argues that it can be bad for bond investors
Especially those who are looking for safety and consistent income.
because it can lead to an overconcentration in the companies with the most debt.
Right.
So just like with individual bonds.
When you're choosing a bond ETF, you need to look beyond just the size of the issuer
And consider things like credit quality.
and the sustainability of the income stream.
That makes sense.
Okay.
Now let's talk more about closed-end funds, CEFs.
They're really fascinating investment vehicles.
We've touched on them a few times,
Oh, we have.
but I'm ready to delve deeper.
Okay. What would you like to know?
What makes them so unique?
Well, as we've discussed, they're actively managed funds that trade on stock exchanges.
Okay.
So you get that potential benefit of active management.
Combined with the liquidity and flexibility of trading stocks.
Right. But unlike those open-end funds like mutual funds and ETFs,
Okay.
CEFs issue a fixed number of shares
Okay. And then those shares can trade.
at a discount or a premium to their NAV.
Right. A CEF might trade at a price that's different from its NAV.
So because the number of shares is fixed, the price of a CEF is really determined by supply and demand in the market.
Just like any other stock.
Exactly. So if investors are really bullish on a particular CEF,
Its price could go above its NAV.
creating a premium,
And if they're bearish on it,
the price could fall below its NAV.
leading to a discount.
Right. And the book really emphasizes that buying those CEFs at a discount can be a really smart strategy.
Because you're getting those assets at a bargain.
And you have that potential upside if that discount narrows.
Okay, so the discount or premium to NAV is definitely something to keep in mind
It is,
when we're evaluating CEFs.
for sure.
Now, what else should we be looking for?
Well, just like with any other income-focused investment, you want to carefully scrutinize the CEF's distribution sources
To make sure they're covered by actual investment income.
and not destructive return of capital.
Right. We don't want to be fooled by a high yield that's not sustainable.
Exactly. And of course, whenever you're evaluating an actively managed fund, whether it's a CEF or a mutual fund,
You need to assess the experience and the track record of the management team.
You want to be confident that they have the skills and expertise to navigate the markets.
and generate those consistent returns.
Right.
Okay, now the book also offers some great tips on choosing dividend stocks,
Dividend stocks can be a great way to build a reliable income stream.
especially for retirement.
When you're picking dividend stocks, you really want to prioritize companies with a solid track record of paying those dividends consistently.
And ideally increasing those payments over time.
Dividend growth is a really strong signal,
That the business is healthy and that the company is committed to rewarding its shareholders.
and that commitment to dividend growth can often lead to higher stock prices.
So you get both that rising income and the potential for capital appreciation.
Exactly.
The book even highlights a company that provides a really interesting example.
What company is that?
New Residential Investment, or NRZ.
Oh, yeah, they're a REIT that specializes in investing in residential mortgages.
They had to navigate a really tough situation.
What happened?
The rise of online retail was starting to really hurt their portfolio.
Which was heavily weighted toward retail property.
Exactly.
So what did they do?
They had to pivot.
Pivot to...
They decided to focus on a different type of asset,
Okay.
mortgage servicing rights, or MSRs.
MSRs, what are those?
Basically, they're the right to collect payments
Okay.
and manage other aspects of a mortgage loan.
So instead of owning the actual mortgages themselves...
NRV started investing in the rights to service those mortgages.
Interesting.
It was a smart move.
How so?
Well, MSRs tend to increase in value when refinancing slows down
And refinancing has declined in recent years.
because interest rates have been going up.
Ah, I see.
So they were able to take advantage of that trend.
And generate some really nice returns from their MSR investment.
Exactly. And because they're not a traditional bank, they weren't subject to the same regulations.
So they had more flexibility to pursue opportunities in the mortgage market.
It's a great example of a company that was able to adapt to a changing market.
And keep generating income for their investors.
The book really stresses the importance of understanding a company's business model.
And how they generate that cash flow to support their dividends.
We don't want to be investing in companies that are funding their dividends with debt or by selling off assets.
Those practices aren't sustainable in the long run.
Okay, so let's move on to business development companies, BDCs.
We talked about them a bit.
They're really interesting.
They are.
They're similar to REITs in that they're required to distribute most of their income
At least 90%,
to shareholders.
which makes them really appealing to those income-focused investors
But they do tend to invest in less established companies,
than traditional banks,
so they can be a bit riskier.
especially during those economic downturns,
So you're balancing that potential for higher income.
with the increased risk of defaults.
Okay, now the book highlights one particular BDC,
Oh, which one?
Main Street Capital,
They have a really impressive track record
who've increased their dividend payments every year,
without ever having to cut their dividend.
which is quite a feat.
It is, especially in the BDC space.
They've been able to do this by focusing on generating that steady investment income.
And by maintaining a really conservative payout ratio
So they're not overextending themselves.
to make those dividend payments.
And I know they also pay a special year-end dividend,
Right.
which gives them more flexibility.
And helps to ensure that their regular monthly dividend stays secure.
Okay, so now let's talk about debt levels.
Debt can be a tricky thing.
It can be good or bad,
It can be used strategically to enhance returns
but it can also increase risk.
and potentially jeopardize those dividend payments.
So how can we assess whether a company's debt levels are manageable?
One important metric is the debt-to-equity ratio.
Which measures how much debt a company has relative to its equity.
Right. If that ratio is high,
It could mean the company's relying too heavily on borrowed money.
which makes them vulnerable to economic downturns or those interest rate hikes.
And then there's the interest coverage ratio.
That measures a company's ability to make its interest payments from its earnings.
Okay.
So a low interest coverage ratio could be a sign that the company's struggling to service its debt.
And, of course, we always need to look at the company's overall financial health
Its industry, its competitive landscape.
and the track record of its management team.
When we're evaluating those debt levels,
Now, the book also makes this interesting distinction:
between what?
paper profits
Okay.
and actual cash flow.
When you're evaluating REITs and other dividend-paying investments,
So just because a company is reporting strong earnings,
doesn't mean they have the cash flow to actually support those dividends.
you really have to dig into that cash flow statement.
To see how much cash they're actually generating from their operations.
Now, for REITs specifically, there's this key metric,
Funds from operations, or FFO?
FFO. It's basically a measure of their operating cash flow,
But it takes into account some factors that are specific to the real estate industry
like depreciation.
and amortization
So FFO gives you a more accurate picture.
of their ability to generate cash from their properties.
Okay. And since REITs have to distribute so much of their taxable income to shareholders,
We need to make sure those distributions are actually covered by cash flow.
not just paper profits.
Right.
Okay. And the book also highlighted the importance of internal management for REITs.
As opposed to external management.
Can you remind us again why internal management is better?
So in an externally managed REIT, the management is handled by a separate entity,
Okay.
which, as we talked about earlier, can create those conflicts of interest.
Because their incentives might not be aligned with the shareholders.
Exactly. They might prioritize their own profits.
Over the best interests of the REIT and its investors. The book has a great example of a REIT,
Which one?
Ladder Capital,
Oh, yeah, they're a commercial mortgage REIT.
with a great track record.
They've delivered really strong returns
And a lot of that success can be attributed to their expertise,
in commercial real estate lending.
their conservative approach to managing risk.
And the fact that their management team owns a big chunk of the company.
So they're really invested in its success.
The book even tells this story about how their management team really put shareholders first.
Oh, I love those stories. What happened?
So a few years ago, Ladder Capital got a takeover offer
Okay.
from another company, but the offer was too low.
The management team thought it undervalued the company,
And they felt it wasn't in the best interests of the shareholders.
so they said no.
They did, and what happened next?
Ladder Capital's stock price went way up.
Proving that they made the right call.
Wow. That's a great example of how a strong management team can really protect and enhance shareholder value.
It's a reminder that management quality really matters.
For sure.
All right, so we've covered a lot of ground in this deep dive.
We've explored so many different strategies and concepts.
Bond market inefficiencies,
CEFs, BDCs,
dividend growth.
building that no withdrawal portfolio.
I hope our listeners have found it helpful.
Me too. And I think it's important to remember, every investor's situation is different.
There's no one right answer.
Do your research,
Consider your own goals,
your risk tolerance,
your financial situation,
and talk to a financial advisor.
before making any big decisions.
We encourage you to keep learning.
Keep exploring.
Take control of your financial future.
Thanks for joining us.
Happy investing.